Hello, everyone, and welcome to Dividend-Play US. I'm so glad you could join me today. Are you looking for a way to generate consistent monthly passive income from your portfolio? Have you ever considered the long-term potential of the healthcare sector? If so, you're in the right place. Today, we're taking a deep dive into a fascinating fund called BME, the BlackRock Health Sciences Trust. We'll explore how it aims to provide an attractive dividend yield of around 8%, how it generates monthly income, and its unique position in the health sciences sector. By the end of this video, you'll have a clear understanding of what BME is, how it works, and whether it might be the right fit for your investment goals. So let's get started. Before we dive into the details, a quick but very important disclaimer. This video and everything on this channel is for informational and educational purposes only. I'm sharing my personal research and opinions to help you learn, but this should not be considered as financial or investment advice. The market is complex, and everyone's situation is unique. All right, with that said, let's explore BME. So, what exactly is BME? Let's break it down using this overview. First, its fund type. BME is a closed-end fund, or CEF. Unlike a typical mutual fund or ETF, a CEF has a fixed number of shares that trade on the stock exchange, just like a regular stock. This means its price can be different from its underlying asset value, which can create some interesting opportunities we'll discuss later. Next, the fund manager. BME is managed by BlackRock, the world's largest asset management firm. This provides a level of confidence, as you have a team of experienced professionals managing the portfolio. Its investment policy is focused. BME invests primarily in companies within the health sciences sector. Think pharmaceuticals, biotech, and medical devices, with a strong focus on the US market. The objective is to provide total return. This means they're not just focused on dividends, they're also aiming for growth in the value of the assets over the long term. Now, for the key strategy, and this is really important, BME uses a covered call option strategy. In simple terms, they sell the right for another investor to buy their stocks at a set price in the future. For selling this right, BME collects a fee, or a premium. This premium becomes an extra source of income for the fund, which helps boost its dividend payments. This strategy is why the distributions are so attractive. The fund pays a monthly dividend and targets a yield of around 6 to 8% annually, which is often higher than you'd find in standard stock funds thanks to that extra income from the covered call strategy. Finally, the expense ratio is 1.1%. This is the annual fee the fund charges to cover all its management and operating costs. So, in a nutshell, BME is a professionally managed fund that invests in healthcare and uses an option strategy to generate high monthly income. Now let's see what's actually inside the fund. When you invest in a fund, you're investing in the companies it holds. This slide shows us the top 10 holdings of BME. You'll see some of the biggest and most innovative names in healthcare here: Eli Lilly, Boston Scientific, Johnson & Johnson, and United Health Group, just to name a few. These top 10 companies make up about 48% of the entire fund, which consists of over 130 holdings in total. This tells us that the fund is quite concentrated in its top picks. If we look at the sector breakdown below, it's clear they are true to their mandate. Over 51% is in pharma, biotech, and life sciences, with another 47% in healthcare equipment and services. It's a pure play on the healthcare industry. This concentration is a double-edged sword. It means the fund's performance is heavily tied to the health of this one sector. But it also means you get direct exposure to the long-term growth drivers of healthcare, like an aging global population and continuous medical innovation.
Now let's talk about performance. This slide shows two very different but equally important charts. On the left, we have the price return since the fund's inception in 2005. This chart shows only the change in the stock price itself, and it does not include dividends. As you can see, the price has had its ups and downs, showing a gain of about 45% over this long period. If you only looked at this chart, you might not be very impressed. But now, look at the chart on the right, price and NAV. This is where it gets interesting for a CEF. The blue line is the NAV, or net asset value. Think of this as the true value of all the stocks inside the fund per share. The green line is the market price, what you actually pay for it on the stock exchange. You can see that sometimes the green line is below the blue line. This is called trading at a discount. It's like buying a basket of stocks for less than they are actually worth. Other times, it trades at a premium, where the price is higher than the NAV. Understanding this relationship is key to finding a good entry point for a CEF like BME. So if the price return chart wasn't the full story, this is. This is the total return chart. Total return shows you what would have happened if you had reinvested all of those monthly dividends back into the fund. And the difference is staggering. While the price return was around 45%, the total return is over 630%. This powerfully illustrates that BME is an income machine. The majority of its long-term return has come from its high, consistent distributions. On the right, we can see the average returns over different timeframes. You can see there's been some short-term volatility, with the one-year return being negative. However, when you look at the longer-term 5-year, 10-year, and max periods, the fund has delivered solid, positive returns for its investors, demonstrating its long-term viability. Since this is an income-focused fund, let's zoom in on the dividends. As of the date of this recording, the dividend yield is a very attractive 8.63%. This translates to an annual dividend of about $3.15 per share. The table on the left shows the one-year dividend history. What I want you to notice here is the consistency of the monthly payments. And even better, you can see a recent increase in the dividend amount. It was paying around 21 cents per month and has since been raised to over 26 cents per month. This is a very positive sign, showing the fund's confidence in its ability to generate income. The chart on the right visually confirms this trend, showing the steady and recently increasing dividend payments over the past 5 years. For an income investor, this is exactly the kind of stability and growth you want to see. All right, no investment is perfect. It's crucial to understand both the good and the bad. Let's summarize the pros and cons of investing in BME. On the pro side, first, high monthly income. With its 6 to 8% average yield, it's a powerful tool for generating a steady income stream. Second, healthcare exposure. You're investing in a sector with strong long-term tailwinds. And third, it's managed by BlackRock. This gives you the peace of mind that comes with professional, world-class management. Now for the cons, or risks to be aware of. First, capped upside potential. That covered call strategy that generates income also puts a cap on how much profit the fund can make if the market has a very strong rally. You're essentially trading some potential for explosive growth for a more immediate income. Second, sector concentration risk. As we saw, this fund is all in on healthcare. If that sector faces a downturn, the entire fund will be affected. And finally, return of capital risk. Sometimes a portion of the dividend might be a return of capital, which means the fund is simply returning a piece of your original investment back to you. While not always a bad thing, you want to ensure that most of the dividend is coming from actual earnings and not just from giving you your own money back, as that can erode the NAV over time. Understanding these trade-offs is key to deciding if BME fits your personal risk tolerance. So let's bring it all together. Who is BME really for, and what role can it play in a portfolio? As you can see, BME is an excellent fit for income investors, retirement-focused investors, and more conservative investors who want to reduce portfolio volatility. It's a fantastic cash flow generator and is ideal for creating that monthly paycheck from your investments. However, it is not the primary choice for aggressive growth investors who are looking for maximum capital appreciation. If we look at its role in different portfolios, in an income or retirement portfolio, BME could be a core holding, the main engine driving your monthly income. In a balanced portfolio, it acts as a key stabilizer, providing consistent income and a defensive layer. And in a growth portfolio, it could be a satellite holding, used to reduce volatility and generate some cash while you wait for your other growth stocks to perform. Ultimately, BME is an excellent investment tool for cash flow generation from a portfolio, leveraging the growth of the healthcare sector. However, it is not the optimal tool for capital appreciation or wealth building through stock price growth. Remember, investing is about finding the right tools for the right job. The most important thing is to understand your own goals and build a portfolio that helps you reach them. Keep learning, stay disciplined, and be patient with your journey. And that's our deep dive into BME. I hope this breakdown was clear and valuable for you. We covered everything from its core strategy to its performance and its specific role in a portfolio. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And if you want to see more content like this, make sure to subscribe and hit that notification bell so you never miss an update from Dividend-Play US. Thank you so much for watching. Until next time, happy investing!